Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Tuesday. Hopefully everybody's having a GGD in the market. You know, I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value, where I allocated my $270, the individual stocks, and how they are performing, as well as my Watchlist and Berkshire Hathaway. So for today, so far, we are down $56, down about 0.12%. Not down as far as I thought we would be. There's been a lot of news in the market today, so usually when it's heavy on news, the market is usually pretty red. But, you know, $70 down today, not super worried. I put more in the market last night with that Altria dividend than what I lost today, so I'm still technically up like $200 today. So, not super worried about it at all, and that just means that there are current deals inside of the portfolio. Then, for the 1 month mark, we are actually up, which I'm surprised, because like I said, it's been very volatile lately, especially with interest rates, but right now we're up about $170, up 0.36% for the week. Again, really short term, so I'm not really worried about this statistic. I'm very long-term oriented, so whether this was up or down wouldn't affect me hardly at all, because I don't really care unless it was down like 50%. Then, of course, we'd have a lot of really good deals in the market, but nice to see a little bit of green. Then we've got the 1 month mark sitting at about $640 in the green, up 1.37%. So as you guys can see, a lot of ups and downs with interest rates and whatnot. Like I said earlier, that's been pretty volatile, but that just means that we're up overall, but we still have a long way to go. I know our high was about 54K, so we're still 47, 48, 49, 50, 51, 52, 53, 54, down about 6 or 7 grand. So still have a long way to go before we reach that peak that I saw before. But it's nice to see a little bit of recovery and some green on that statistic. Then we got the 3 month mark. This is where everything kind of went down. As you can see, the portfolio tanked. We were at about 54K, I believe. We got close to it. I know that for a fact. So like 53.6. So really close to 54,000. We dropped. I know interest. There was like political stuff, of course. There was like the war. There was also like interest rates were hiked, and like the people didn't really know what the future was going to look like. So this has that all kind of priced in, all that market fears priced in right here at that 3 month mark. So not super worried about it, but there were some really good deals a few months ago that have, some of them have recovered, but we still do have a few really good deals within the portfolio. Then on the 1 year mark, we are up about $4,200, so we're up almost as much as we were down. So for the 3 month mark, we're down a bit more than we were up in the year, so we're down about $2,000, but that's okay. For the year, we are up about 9.8%. So about what you can expect from the S&P 500. Usually it's like 7 to 10%, I think, is the annual average for the market. So matching the market is not bad. Statistically, most people don't even match the market. Usually individual or retail investors, smaller investors, don't even match the market. So I'm happy with that 1 year return sitting at about 9.8%. Then all time since 2018, I believe it was April. Yes, April. I thought it was May, but it's April of 2018. We are up $12,726.26, up 36.62% all time. So long term, we are still doing very, very well. The portfolio maxed out at, I think it's like 54.2. So still about $6,000 down from our all-time high, but not worried. We can just take advantage of quality as much as we can right now. I want to take advantage of the quality companies that we already have, and if the months line up, I want to add some companies if they stay at these deflated prices long enough. So right now, we have a buying power of 1782. And I did allocate that back into Altria because the math added up that way. So it just made more passive income going back into Altria than it did going into Cracker Barrel. So starting off with Realty Income, we're sitting at about $69.40. 41 shares, around $9,800 of market value. Average cost is $67.17. 20.6% of the portfolio is in Realty Income. Today we're down $26. Total, we're up $311, up about 3.3%, with a dividend coming in on, I think, Friday or Saturday of about $35. Keep in mind, guys, this is a monthly dividend-paying stock, which I love. It is also a dividend aristocrat. This is one of those that I just want to keep buying, but at current prices, I can't pull the trigger simply because it's above my average cost. But it is one of my biggest, I believe it's my 4th biggest position right now, so I want to keep it within the top 5, so I like that the overall size of this position, but when it comes to the quality of the company and how much I want allocated to it, I would love to have more. This honestly should be in my top 3 or top 4, so I want to keep it in the same amount, as in, like, I don't want, say, like, Walgreens to pass this company, but I do want to make sure that it boosts up every single month, so I want this to be a bigger position, because I just love the fact that I own this, because in turn what this means is I own real estate that gives me monthly cash flow. So this, in my opinion, is the best way to make passive income in the stock market if you want exposure to the real estate sector. They have a phenomenal group of tenants, just a crap ton of properties, and they're always expanding, and they're always rewarding shareholders. That's the other thing that I love about Realty Income, is they're always adding more properties, which means that the income should statistically keep going up, because not only do they get more properties each year, but they also have within their lease agreements small bump ups to the rent as well. So they're getting more, they should be annually getting more rent per tenant per year, which then, as they add more properties, should help build the dividend up as well. So love Realty Income. I like the position. I like where it's sitting at when it comes to the position in my holdings, like how big of a position it is, but I would like to add more simply because it's such a high quality company, and I love the feeling of owning real estate without doing any of the headache work. Like, I don't get a call from tenants at 2 o'clock in the morning. So this is the best of both worlds for me. Next, we've got Altria, and guys, I did go ahead and reallocate the $270 back into Altria. So now we've got 306 shares. So keep in mind, guys, we bought 6 shares off of interest. So we didn't touch the golden goose, right? The golden goose is the money that's in Altria right now that's producing that dividend. So we didn't have to sell any of this position, but we got 6 more shares, which is $4.20 more in dividend payments per quarter from this company. So now we have 306 shares, about $12,950 of market value. Average cost is right on $47.50. 27% of the portfolio is in Altria. Today we're up $106. Total, we are down $1,500, down 10.8%. And here's the thing, guys, I cost down average here. So like I bought it at a lower cost than what my average is. So I got a better yield on these 6 shares than I had on the previous 300. So overall, so I love that as well. And like I said, the reason that I put it back into Altria is because I went and I figured out what the amount of shares I'd get for each company. So like Altria was 6 shares, Cracker Barrel was 3, Aflac was 4, and I believe Walgreens was 5. And Altria's 6 shares were cheaper than Cracker Barrel. It's pretty much 2 for 1. But the thing is, Altria pays such a big dividend at 90 cents that even though Walgreens shares were cheaper, I still came out ahead because Altria pays such a big dividend. So happy that I got the best bang for my buck within the portfolio there. And like I said, it pushes us even more past that $300 mark. I think we're up to like $306 or 300 and I think it's like $12 or something like that. So I did decide to reinvest back into the company because that's the best place that I could find to reallocate that capital. Next is CocaCola, which, again, love this company. Great consumer staple. 2.3 shares, $144 of market value. Average cost is $62 a share, well, almost 63. 0.3% of the portfolio is in Coca-Cola. Today we're down 62 cents. Total, we're down 14, almost 15 cents. And right now, it is a little bit below my average cost, but I'd want to see this get closer to $60 a share before I pour money into it. So I have a little bit of leeway. If I could get it even lower, closer to that like $55 mark. That's where I like 60. I'd do it just to lower my average cost. But if I could get it into like 55 range, I would pour money into it like I did to AVV. And Coca-Cola on the market is my favorite stock. Like I love it. I drink it every single day. It's one of those like brands that are just like, you know, just iconic. I love Coca-Cola, but I do not love it at these prices. So I want to wait, but really take advantage when I can. Next, we've got AVV, my best performing stock, 85 shares, around $13K in market value. Average cost is around $87 a share. 27.2% of the portfolio is in AVV. Today, we are down $65. Total, we are up $5,500, up 74.7%. Love AVV, and I would add more, but they're just too expensive here. I bought them a few years ago, and I thought I saw, you know, an opportunity, and I'm happy that that paid off, and I'm really glad I never sold any shares. I did add a little bit when it was down closer to the $100 mark, but I will not be allocating any more capital to this position because it's so overvalued. Next, we've got Cracker Barrel, which is my newest switch out from AT&T. We've got 12 shares, about $1,100 of market value. Average cost is $85.73. 2.23% of the portfolio is in Cracker Barrel. Today, we're down 12 cents. Total, we're up $31, up 3%. I was originally planning on buying shares of Cracker Barrel with my Altria dividend, but putting it back into Altria was just a better bang for my buck when it comes to the dividend payment. So, following that, we have Aflac, a dividend aristocrat, 180 shares, 10 grand in market value. Average cost is around $61 a share, around 21 or a little over 21% of the portfolio is in Aflac. Today we're down $59 total. We're down $900, down 8.3% at a cost of around $55 a share, which is really close to the 52-week low. My average cost is $60, so a great cost down average opportunity here. So if both Aflac and Walgreens stay down at these levels, because I know Walgreens is down as well for today, I will try to split the allocation. I'll buy a couple shares of Aflac and I'll buy a couple shares of Walgreens. But I do love Aflac. They are my favorite insurance company, and I love insurance. Like, if I could just buy, like, State Farm, USAA, American Family Insurance, and Liberty Mutual, they'd all be in the portfolio. But they're private, so I can't purchase them. But insurance is my favorite business model. Honestly, Chubb and Travelers both have been on and off my watch list, and eventually, when I get to the point where, say, I could buy a share of both of them a month, I'd probably do it. So, like, in the future, when I'm, you know, sitting on like $3,000 worth of dividend payments a month, or you know something of that effect, where I could like live off of the payments and then just reinvest the extra, or you know just invest all of it. I would not mind adding more insurance, and Chubb and Travelers are two of the companies that I've done enough research on and I'm comfortable with them, and I'll keep tabs on them and whatnot. But I do want to add more insurance, but just not at this time currently. I want to be able to reinvest, and I want to take advantage of Aflac while I can. So I do plan on buying more Aflac stock, and eventually I will be buying Berkshire due to the huge footprint that they have in the insurance business, but it is by far my favorite business model. Then we've got Walgreens, which is down to about $38 a share. 15 shares, around $570 of market value. Average cost is $43.18. 1.2% of the portfolio is in Walgreens. Today we're up $8. Total, we're down 80, down 12%. I do want to add more cash into this position, probably another $500, just get it to that $1,000 mark. But I do definitely want to take advantage of their great dividend aristocrat. They have a low payout ratio. They are just, in my town, it seems like they're on every corner. So love them. And also on top of that, they are also one of the biggest tenants of Realty Income. So this is why I love Realty Income, and why I love owning both companies, right? So Walgreens leases to Realty Income, and they pay Realty Income rent, but Walgreens is responsible for the building. So that's why I love Realty Income's business model, right? But this way I get paid rent from Walgreens, and then Realty Income gives me that rent money, but I also get dividends from one of the, I think the biggest tenant from them, being Walgreens. They pay me out too. So they pay me from their profit, but they also pay me because they pay Realty Income. So I love owning both sides of that transaction. And then, of course, we've got my watch list. We got PepsiCo, which I'm not buying you until you hit about 155. So got a big drop there, but I do want to own their brands. Then Procter & Gamble, kind of same deal as Pepsi-Cola. I don't really want to own them unless they hit about 135. So got a $10 price difference, $9 price difference there. And then T. Rowe Price, I would definitely scoop up at these prices, about $10 off of their high. Or sorry, $10 off of their 52-week low, with over $100 of upside. So love them. And then Berkshire Hathaway at 277, I'd buy them at 300. So anything below 300, I'd definitely buy. So 2 buys on the watch list right now, and 2 that I would just sit there and let them look pretty at those high prices. So with that being said, guys, thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. And when you do, hit the bell notification. And I have noticed lately that a lot of the people that are watching the videos are not subscribed. There's like 49% of you guys not subscribed. So if you're watching on a regular basis, you might as well hit subscribe because you don't want to miss an episode, right? So thank you guys so much for watching, and I'll see you guys tomorrow with another Robinhood portfolio update. Take care, guys.